Well, thanks. Welcome, everybody. Glad you're here. Let's get started. So today I'm going to talk about two very unique option strategies that are good for any kind of market environment. But when you get into really extreme markets, uncertainty where you really want to define your risk, keep it nice and tight, but also allow yourself to have big returns. These are two strategies that are fantastic. Plus, they're great for hedging. So that being said, let's get started. So the following presentation here today is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So to me, the secret to trading profits actually comes down to three major points or things. First is direction, and then timing, and then really good risk management. So through the use of options, which were created for actually hedging, we can accomplish that risk management side of things, but also structure trades for, very high reward on the capital at risk. So that's the thing about these two strategies that I'll show you today, that you can really trim your risk down and still have potential for big reward. So option trading has many more advantages than trading stocks, but as you probably know, it's a bit more complicated as well. But once you understand the benefits and the advantages of options, and especially for me, option spreads, you're really never going to look back. So when used correctly, option spreads are going to provide defined trading risks. You can really get your risk defined down to exactly what your worst case scenario would be. It's going to lower your capital at risk. It's going to provide you greater leverage for your trade, for your returns. And certain options strategies are unmatched for hedging. So these two strategies are those two that are fantastic for hedging as well. Now, over my 30 plus years of trading options, I've found that the most valuable go-to option strategies that can help literally any trader or investor out there more than any of the other strategies are the butterfly and the long condor option spread. Now, the huge advantage that these strategies offer you is that they're kind of unique option framework that allows you to structure or construct trades that will provide more consistent and greater returns in any type of trade environment, especially when you get in that high uncertainty type of volatility market. So as volatility goes up, that increases the option prices and the premiums. And so this strategy has a selling component which can also take advantage of that. So because they are also structured where they only require a small amount of your hard-earned capital, your trading returns are going to be greater and your trading risk is going to be very, very small. So that's always a major win-win. So if you can get your risk down to a small enough level where you can handle that and you have a potential for big rewards, that's a winning combination. Now the butterflies and the long condors, they're very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So in other words, you can learn how to trade a butterfly or the long condor, and you're going to be covered for both your offense and your defense. So your goals and your protection, your profit and your hedging. Now, these two strategies can work no matter what the markets are doing. You can be in an uptrend, downtrend, or a sideways market, and you're good to go with these strategies. They can provide income from stocks that are going nowhere. They'll help to eliminate the stress of having to be perfect on a stock's direction or overall market. They're going to help you to eliminate the time decay expense that you encounter from long decaying options. They're going to help to really take the unsettling guesswork out of your trading, and they can be structured for very, very low cost and low capital at risk, and structured for providing you a 10-to-1 or higher reward on your risk. So we'll take a look at a lot of different examples here in a few minutes so you can see exactly how these things can provide some amazing advantages for your trading. Now, the other benefits are that the butterfly and condors are very flexible, as you're going to see ahead today. And once you learn the fundamental setup, you can then adapt these option strategies for both your goals and your market insights. So if you're wanting to structure trades that are more kind of a market that's going nowhere, delta neutral, you can do that. But to me, the real beauty is that we can also use these strategies for directional trades. So if you've got a bullish or bearish exposure or bias to the market, and you feel pretty sure about that direction, where it's headed, you can construct these trades for those kind of targets. But the big plus is that if you're wrong, this is the big plus, especially when you get into these kind of uncertain times of uncertainty where things can change in a second with a headline. that if you are wrong, the butterfly and long condor are really going to help you to manage your risk, keep it small, but at the same time, potentially retain that large potential returns. So that's a win-win for any market condition. But when we get in these uncertain times with a lot of headline-driven events, that really helps to pay off. Now, but let's be real, these types of option spreads will not give you that unlimited profit potential, such as if you're just long calls or something, but they're going to usually cost you a lot less and then, buying outright, and they're going to offer you, again, amazing risk-reward trade setup. So this means that the butterflies and long condors can significantly increase the probability of your winning trades while also reducing your risk. So that's what it's really all about in trading, is to be consistent with your returns. You want a nice, as smooth equity curve as you can get. And to me, it's kind of hit, singles, doubles, and occasionally you're going to hit that big home run. Now, also, when we look at the butterfly and long condor, they're fantastic for hedging. So when you mess something up, which I'm sure here nobody ever has that problem, but if you do get in a situation where you have a trade going against you, these two strategies can be a really fast way and a low-cost way to cover your you-know-what pronto when that position starts to move against you. And I've literally found no other hedging strategy that comes close to using these two for a hedging type of strategy setup. Now let's take a look at what it does for you. So if you construct a butterfly or long condor around a strike that is under pressure from another core trade, such as, let's say you had a credit spread that starts to go against you, or a debit spread, you can construct a butterfly or condor around that core trade and immediately neutralize reducing that risk and controlling that risk by doing this strategy. So it's the best way I've found if you want to control risk and do it really in a fast manner to control and reduce your risk. And we'll look at some examples here in a little bit on that. Now, excuse me. Got hung up. Okay, here we go. Sorry about that. So the way it really helps is, since the butterfly and the condor, long condor, have this selling component to the option spread, what it does is when you set up this hedge around a core position, you're taking advantage of that time decay component, which comes from selling options. All right, so this hedging strategy then really helps to take advantage of that time decay component while you wait things out. So many times you've probably been in a situation where you put a trade on, it looks great at first, and let's say you went long or something and it's going up, everything looks fine, but then some headline comes out and sabotages your trade, and then all of a sudden it starts pulling back. You're not sure what to do. So a lot of times you might end up stopping yourself out, then the trade goes back and right in your favor, and you're thinking, gosh, why did I do that? But if you do this hedge where you can use either the butterfly or long condor or hedge around that core trade, what it does is it immediately neutralizes and reduces your risk, but it also then provides you time for that original position to potentially stabilize and then move back in your favor. And while you're waiting, you're kind of getting paid from the time decay of this strategy. So at that point in time where you want to, then you can lift your hedge and let the trade roll for what it's worth. Now, when we look at the condor or the butterfly, it's a very simplistic trade setup. So if you look at this example here, this is like a call debit spread, all right? So here you'd be long a call, short a call, or you could be, do this for puts as well. But in this example, the total risk is your debit paid of $300, all right? So right here, so your long call, short a call. Now, what I always try to teach my members and clients is that, never try to lose or never lose your full at risk, even if you have a debit spread or credit spread, because you'll be more consistent with your trade. So we can neutralize this trade quickly and reduce that risk. All we have to do is sell a call credit spread against it, and we can convert it to a butterfly to hedge that trade. So here, switch the slides here, we just sell a credit spread with the same short strike and bring in $200 credit. All right, so we bring in $200 credit, so short a call, long a call, and now we've created what we call a balanced butterfly. Now with this structure here, we were originally long a call here, short a call, okay, then we shorted another call, bought a call. So we reduced our risk here in this example to $100. Now this is what we call the profit zone or profit tent. And if you go out at expiration, it really pays off the biggest at expiration when you're really sucking out what's left of time decay and volatility. But here you've got a potential for a huge return on your reduced risk, or you can leg out. You could close out the call side or the credit spread side and let it run. So that's one structure. That's one great advantage of the butterfly for a hedge. Or we could do the same using what we call the condor, the long condor. So different from the iron condor, but similar to the butterfly. So if we did that, we're going to widen out our profit zone. All right, so basically the same structure, but the thing that I like about it is we're widening out the profit zone. So in a butterfly, we'd be kind of short there. So it's like you've got to, thread that needle. It's a little bit tighter for you. But if we can do the widening, then we've got this bigger profit zone. So it's a really great structure for just establishing a trade with low risk but high return, or for converting a trade that was going against you into this condor. And we also are going to reduce our theta decay from doing both of these types of trade setups, which is to me a big plus. All right, so let's take a look here at the next things that involve with the butterfly condor. So what are the core concepts that make the butterfly and long condor really amazing and unique? Well, it really comes down to, the most important option factor for profit generation using these two strategies, and that comes down to understanding how option pricing works and the concept of time decay, or what we call theta. So, and how that affects the price of your options. So let's take a look. Now, when we look at, options in general, the core concept behind the option price is going to be time decay and implied volatility. So the first main component is time decay or theta, and we can actually then measure how much of an impact that time decay has on your option each and every day, and that's what we do using the theta. So theta tells us how much that option price will go down over time. That's the rate of your time decay of your stock option. And this time decay occurs because what we call the extrinsic value, or that time value of the option, goes down, and at expiration it's going to be zero. So it's the decaying component of that option trade. So time's going to go to zero and volatility is going to go to zero. So when we're selling options, we're in essence selling both time and volatility. So when we look at the butterfly and long condor, we can take advantage of that kind of selling side component when we construct these trades. Now here's an example. So let's say you went long that fantastic company XYZ, and it's trading at 45. So not long, but let's say your XYZ is trading at 45, and you think you've got a target, you think it's going to go down to $43 based on your hunch or your trading model or whatever you're looking at. So we could construct a trade then, very low risk, targeting a $45 move to 43. So typically when I set up trades, I want to have a price target in mind. Typically I will use Fibonacci levels, moving averages, and then what we call the expected move of your options. But in this example, we want to target 43, and we're going to keep it really low risk. So I could buy the November 44 put. I'd pay $2.38 or $238. Remember, one option contract's equivalent to 100 shares. So this would be $238. So that would go out of your pocket. And then I could sell the 43 put against it, that target. That would be our target. And I bring in $1.67. And then I sell it again, and I buy the 42 put below it to cap my risk there. So what I've done is just created this butterfly, and this is kind of what I call a narrow wing butterfly. So you can see the strike price is 44, less 43, 42. It's $1 between each strike, right? So if you look at your cost then, your cost is your debit paid here for that 44 put, the 106 for the 42 put, and then you brought in the credit of $1.67 twice, times 100 to make it into equivalent for an option, our option spread here. So the cost of one option spread on this butterfly then would be $10. So if everything went wrong for you and it went straight down or straight up, you would lose $10, but very defined. And in this example, super low risk. Now the profit is you take your middle strike, say in this example 43 less the lower strike, and that's $1 or $100, and then less your debit cost here of 10, and that gives you your potential profit. So in this example, 43 minus 42, minus that 10 cents equals 90 cents times 100 to convert it to your option price spread. So theoretically, if it went out exactly at that $43 strike at expiration, you would make $90. Now, you're never going to make that exactly because it's just because of the way the math works. But you're going to get, a lot of times you can get pretty close. But if you look at this, the big takeaway is you're risking $10 to potentially make 90. So that's a 900% return. So you're risking $1 to make 9, right? So of all the option strategies, you're not going to find one that offers a better reward on your risk or return on your risk than the actual D butterfly. Plus the theta is always going to be positive. You got a nice positive theta, so no time decay. So here's another example. So this is SPY. They're great for index options, ETFs, whatever. But here you're long the 203 SPY call, and that's going to cost $3.10 or $310. Then you short the 205 call against it. So you're going to bring in $1.70 or 170, and then you sell it again. All right, so you've got then a total credit brought in of 340. You've got a debit cost there of 310, 340 credit, and then you buy the 207 above it to cap that risk, and that's 70. So if you look at the total cost on this trade, you've got a maximum potential cost of $40. All right, so that's the maximum at risk. And the difference, it's a $2 wide spread. So you've got a potential theoretically to make $160 if at expiration it was going out at your short strike, which I call the target price right here, or the body of the butterfly. You would make that $160 on your risk of 40, so that would be a 400% return. All right, so that's the beauty of it. So we can construct butterflies for a lot of different reasons and different variations in the market. They can be used for hedging, they can be used for profit, they can be used for a lot of different circumstances, but offers you a great advantage to take advantage of this structure. So the butterfly is really, that's kind of basically how it works. Now, the next thing is, well, then how do you know which butterfly possibly to use or condor, and when do you use it? So let's take a look. So in my opinion, one major goal of every trader really should be to select trades based on what's going to provide you the most consistent positive return with low defined risk, and not always the greatest return. So again, in trading, you want to stay in the game, and to me, it's just being consistent and having, kind of chipping away. We're not going to go swinging for the fence on every trade. We want to be consistent and really keep our risk defined and know what that is, but also have the potential for a big payoff on that risk. And that's what's great about the butterfly and long condor. But when you're looking at the different trades that you have, there are all types of different option strategies out there. So you want to look at each strategy and see how they work, and then be aware of the strategies that are available to you, how they work, and which ones are best suited for the market condition you're trading in, and maybe for your style of trading or your risk profile. So everybody here today is going to have a different time frames that you might trade. You might not be able to be at your screen all day. Maybe you look at the market once or twice a day. And you might have Charlie has 100,000 in his trading account, and John only has 10. So that's going to make a difference too on your risk profile. But what you'll find out is once you understand how to use the butterfly or long condor, you can use it for whatever size trading account that you have. You could have a trading account literally of $1,000, and you can do butterflies and condors, and it barely puts a dent into your account because the capital required is so small. All right, so that's the beauty of it. And I remember I had an over-counter brokerage company. I set up the option desk for them, and they were we used to do a lot of oil options for hedge funds. We were doing a 25,000 contract butterfly for this one hedge fund, using oil contracts for it. So basically the point is you can do 1,000 contracts of butterflies or condors, or you can do one. So it's a great strategy for anybody out there once you understand the concept. Now, when we look at the butterfly, there are a number of variations of the butterfly. So I kind of call it the butterfly family. You can do butterflies using calls or puts. You can do what we call the broken wing butterfly using calls or puts. You can use what I call the unbalanced butterfly, or the ninja butterfly. It's a ratio butterfly. There's a wide wing directional butterflies, iron butterflies, and then hedging is a whole nother fantastic category. and then the long condor, which is kind of a little bit of a takeoff on the butterfly. We can widen out that profit zone. So let's take a look at a few examples and get a better idea of how these work. So I'm going to show you a bunch of different examples here today, different conditions, and show you the great benefits for these strategies. So first we'll look at the butterfly, all right? Now when we look at the butterfly spread, we can adjust the risk and the profit based on the wingspan of the butterfly. All right, so if you are somebody that likes to collect butterflies or birds or something, you're trying to catch it, the best way to catch it is with a big wide net, right? So you're going to have an easier time if you've got a bigger butterfly net than a small butterfly net to catch the butterfly. So we can then control the risk and the profit of a butterfly by the wingspan. So basically either using a big wide net or a small net. Now, if we use a big wide net, we've got a big profit zone. So, we can really take advantage of that, but it's going to increase the amount of potential risk that we put on the line. Or we could do a very narrow wing butterfly. It's going to be a structure where we can have very little capital at risk, but we're going to have less return. But the return, if we do nail it perfectly, is going to be tremendous based on that small capital at risk. So I want to show you a lot of these different variations today so you can see really how amazing this strategy really is. All right, so first let's take a look at a narrow wing butterfly, and this is on SPY, the ETF, the S&P 500 ETF. So you can do this great for ETFs because they have a lot of good liquidity, or the index options such as SPX or NDX, things like that. So if we look here at the SPY, this is going to be an example. The first one, a narrow wing butterfly with a dollar wide spread or $100 wide spread. So in this example, this was doing a directional butterfly using a call butterfly for directional move up. All right, so if we want to have a directional trade, we can use a call butterfly if we want for an upside move, or I'll use a put butterfly for a downside move. So in this example, I like to use Fibonacci for targets and also option activity. So in this example, the SPY was trading right here about 265 in that level. And we were looking for a move here, very short duration, very short move up to this fib level 618. And there was also a lot of option activity there. So it gave a great target. So you want to have a target. And then when you have a really good defined target, that would be your butterfly, body of the butterfly. So the butterfly gets the name because your short strikes are the body and then the wings are, your long side of it. All right. So in this example, it was trading at 267 and we were just looking for a move over 2 days right there, but we wanted to keep it, since it was a really short duration trade, keep the risk real low in case, we ran into trouble. So we're targeting 273 and very short duration. All right, so this strategy, you can have very little moves, very short duration trades, and it can give you great return on your risk. So the trade setup was then targeting 273. So it was to structure to buy the 272 call, sell the 273 call. So if you look at that, that's what we call a call debit spread. And then selling another 273 call and buying the 274. So there's your call credit spread. So we did this for what I call a narrowing butterfly. So it's a dollar wide spread between the strikes. All right, so that would be $100 per option contract minus your cost of 10. So here's the cost, 10 cents debit or $10. So theoretically, this trade, if you went out exactly at expiration at 273, it could make $90 per option butterfly spread. So if you did one, that would be 90. So that would be a return of 900%, right? So risking $1 to make 9. Now this went out with a profit of $70 per spread, which is, if you were just to look at that, hey, I made 700% return on my trade, you were thinking, wow, how'd you do that? Well, butterfly, and you can do even better than that with the butterfly. And that's over 2-day duration, all right? So they're great for shorter duration because you're taking advantage of that selling component, and then it makes it really great for hedging and just a lot of different things you can do. So here's the risk profile, what it looks like. So this was going out at expiration on the 16th, and it was trading right here, not quite exactly at that 273 body short strike, but very close. So 273.08. So see all that little black area in there? That's what's left of the time and volatility. And so sometimes you want to be out of out and closed out by the expiration at the end of the day. So it's kind of hard to nail it perfectly. But this was pretty close. So it was up, it went from 10 cents or $10 per option spread to 80 cents or $80. Okay, so there's your profit per spread of 70, which is on your risk of 10, a 700% return. So in this example, 4 contracts, that was up $280. And so if you did 4 contracts, your total risk on that trade going in was $40. So that's the thing that's really, to me, pretty amazing. And the advantage is you're taking advantage of time decay, you're taking advantage of volatility collapse, and offers you high return on capital. So at expiration, time goes to zero and volatility go to zero, and that's what we're taking advantage of from the selling component that makes this part of the butterfly. So that's a narrowing. Now, if we want to expand that and widen that net out, we do a wide wing butterfly. So here's an example of using the butterfly to short the NASDAQ 100 QQQ. Now, I don't know about you, but shorting this market has been pretty hard. You don't get a whole lot of follow through to the downside. So what we've been doing, if we do short the market, our tendency is usually to do it with some type of butterfly, structure. So the great thing too is we could start out maybe with a put debit spread, then convert it to a butterfly. A lot of different variations that we can do. But this is a short trade setup on QQQ using a butterfly with a $3 or $300 spread width. All right, so in this example, this was back in mid-September. The market had crushed down here and it snapped back. So we get a lot of times when you're looking at short trades, they tend to go down, but then they'll have a snapback and what I call a retracement into moving averages. So this was to take advantage of what we call a retracement failure. So it came down and it retraced back up here to these key moving averages. So we're looking to short it if it failed. So this was a way to do it with very low risk. So the trade was then structured. It was trading at 276. And we had our fib levels here. We were looking for a move down to this 270 area, 265 down here. All right, so we targeted 270 to the downside. So this was doing a put butterfly. So we bought the 273 put, sold the 270, okay, and then sold the 270.67. So put debit spread and a bull put credit spread together, a wide butterfly of $3 or 300. So look at the risk here though. So the spread width was $300. The cost of this trade, 30 cents, $30 debit. Super, super low, right? So if you're wrong, the max you would lose is 30 bucks. But the potential profit was 270 if at expiration it went there. Now that'd be a 900% return on that risk of 30. Now 2 days later, we hit our target, so we went ahead and closed it, and it did pretty good. But the whole key here to me was the risk. I always tend to look at the risk first. All right, so this was trading right down here at 271. And at that point in time, it was close enough to our target. We went ahead and just closed that out. So at 271 right here, this was up $65 per spread. So it went from 30 cents to 95 cents. So 65, but the risk was only 30 bucks. So that's over 200% return, in that short period of time. So that's an example there. Now here's another example of GLD, the gold ETF. This is a wide wing butterfly of a $500 wide. Now with GLD, we were looking at, this was in July, we were looking for this to break out over this 170 level. So this trade setup, we did a butterfly, keeping our risk super low, and we were targeting 175, again, based on Fibonacci levels up here. So what we did was we bought the 170 calls, sold that 175. That was the target. Then sold the 175, bought the 180. So $5 spread width or $500. But the cost of this trade, 89 cents or $89. So potential profit would be 411 or 460% or 62% return. Now, when it hit our target again, you take profit. So here was hitting 174.50. And this was on the 22nd, so went ahead and started taking that profit. So at that point in time, this trade went from 89 cents to 299, so it was up $210 per spread, or $236 right here, on that risk of $89. So again, the beauty of low risk but high return on your trade. and big fat theta. Look at the theta. See, this has what we call positive theta. So we're getting paid on the butterfly in this example, not almost $20 per day you're getting paid from that positive theta. So that's the other beauty of it. So if the market was just churning sideways in this area as you get close to the expiration, you're getting paid right there with that big, huge, fat positive theta that it offers you. Now here's another really great example of how to incorporate. This is a wide wing butterfly on Amazon. So this is $10 wide or $1,000. Now in this example, Amazon was trading down on the support level of a 200-day moving average. So we were looking for a push to 1830. So it was at that point in time trading at 1782, and we were targeting 1830 into kind of a fib level. Now think about this. So if you went out and you bought 100 shares at that point in time, when Amazon was trading at 1,782, you're out of pocket here $178,000 roughly, right? And so then let's say it did hit your target of 1830, so you took your profit. So you made $48 per share, a 2.69% return. But think about your risk there. You're out of pocket $178,000. In this example, you could do a butterfly and be, in this example, out of pocket $80 per spread. So you're controlling a price, an option, or a underlying security that's valued at over $178,000 for $80. All right, so this was doing an 80-20, 1820 long call, sold the 1830 here, and then bought the 1840. So $10 between the spreads, so 1,000 less 80 is your potential profit, then would be $920 per spread if you nailed it at 1830 at expiration. So that would be 1,150% return. Now I'm never expecting that to happen, but that just shows you the magnitude of it. But here's the other fantastic advantage. So this was on the 6th. This was at expiration, going into the expiration. And right here, early in the morning, Amazon was trading right there at 1836. So at that point in time, it went from 80 cents or $80 to 230. So it was up $150 or 187% return. Not bad, all right? But that was in the morning. But look where this was 3-4 hours later the same day. So going into the close towards the end of the day, now the spread had gone from 80 to 695. So it was up 614 or 769. That's the other great advantage, is that we're taking advantage of that time decay going to zero and volatility. So just within the one day, this thing went up another 400%. Now here's another interesting one. This is the Batman butterfly. So a lot of times we like to look at pinning trade setups for monthly expiration. And so in this example, we were looking at Microsoft was trading right here about this kind of the middle of the range, 190, and we were looking for a potential target up to 200. There's a lot of option activity, or down to 180. So the butterfly was so cheap, we could do both sides. So we did a butterfly targeting 200, and we did a butterfly targeting 180. And the cost, look at the cost of these trades. This is such an intriguing part of it. The cost of the 182.80 butterfly was $15 per spread with a potential profit of $235. And then the call side was $17. So in this trade, the maximum risk was $32. So we could target both sides of where we thought it was going to go and risk $32 with potential profit of $218. The spread width was $250. So this went out with a profit of $63 on that risk of 32 for 197% return. So that's another way to use it. There are just so many different ways that you can use these strategies. Now here's the long condor spread, and this is a really good one. I like to go to this one a lot of times for the first leg of a spread hedge, okay? So it's going to reduce your theta decay. It's going to give you really good low capital at risk and high return. So we can do calls or puts. And in this example, this was taking a SPY trade that we set up for a put dev spread and converting it to Condor and created a free trade. So SPY was trading right in here about 275. We were looking for a short trade down here to about 270. So the initial trade was doing a put spread, 273, 270. And then that was a cost of $65. So nice positive risk reward on this one. Spread with $300 less cost there. So potentially if it closed below 270, we'd make 235 or over 300%. But again, since these shorts had tended to whip back up, this trade we set up to take profit. When it hit there, we took profit and got on part of the trade for $98 per spread, so nice return. But rather than closing the whole trade out or waiting, we were able to convert it to a long put condor by, when it hit down to the low target, we sold the 268, 265 bull put credit spread, bringing in $65 credit. And that created a zero risk trade because we offset the original debit cost of the put spread, which was $65, by selling the credit spread at 65 credit. And so we created this put condor with zero risk. All right, so we have zero risk. Now, if it went out between the short strikes, it'd make 300. It went out right here, so we closed it out, but that was still a profit of 164 per spread on zero risk. So just, a really neat way, if you think about steps, when trading is the fun thing with options, you can think a couple steps ahead at all times. So like playing a game of chess or cards or something. So trade one, if you took it off there, made 98 or 150, but trade two, if you converted it, made 164, and you were doing that on zero risk. So just a lot of things you can do. And if you'd like to learn more about how to master these really high reward, low risk strategies, two things. Hopefully you got enough information here today where you can start, doing some of these things here today or tomorrow. But if you'd like to really learn how to master these trade setups, I've got a fantastic workshop that we did. That's a 6+ hour trading course, just specifically on the butterfly and long condor. And the other great news is you're going to get additional 8 bonuses for this course, and it's only $97. So use this link here, and you'll get this on demand, and it's yours. Let me show you all the different bonuses, and it's yours forever. And then hopefully you'll join us for other events that we do at Power Cycle Trading. So you should be able to just click on that link here, and that will pull up a payment link here, and just use credit card or PayPal for that. Now let's take a look at your bonuses, then I'll go through what's in the course. So you're going to get everything here just for today's price of $97. You're going to get the 6+ hour recorded course, which is 100% on the butterfly and the long condor. You're going to get my options beginners course, is a new course. If you're not just starting out, this is a good one to add to your library. And you're going to get my other option beginners program that you can also add to your library here. And then my stock portfolio hedging tutorial. So this is a really nice tutorial on how to hedge stocks, or even your stock portfolio using what we call a protective collar. So that's just going to be part of the bonus here. And then we'll do a live follow-up Q&A probably in a week. You'll get an email with that link for that, and that will also be recorded. Then you'll get my option trading tutorial. It's just basically another course on options and the option Greeks and probabilities. My option trading manifesto, which is 15 other different option strategies, my power tool guide on the Greeks, and then you'll get a trial membership for 30 days to my trading club. If you'd like to stay on, it's $97 a month, or you can do annual membership. And you can start the trading club whenever you want. You don't have to start it right away. Just send us an email, and we'll start it when you'd like to start it. Now, with the butterfly course, here's the link again for everybody. Just make sure you should be able to click on it or copy and paste. So this butterfly course, 6-hour recorded course, broken down in 30-minute modules or less. So it's kind of easy to go back as a chapter of book and go through the areas that you need help with. You get the trading manual, which is my PowerPoint. My courses are very detailed, lots of trade examples. So it's basically a blueprint course on how to use butterflies and condors for income, profit from directional trades, non-directional, and hedging. So part one of the course, you'll get, we go through the option Greeks that are important for the butterfly condor, how theta decay impacts the butterfly condor, and volatility, the impacts and importance of that, how that works on the price to make these a very effective trade. And then pricing the options. So for any of your option trading, this is a great part one of the course. And then another big part is standard deviation, how we use standard deviation to forecast probable direction. So you can use this to help you forecast price direction based on your option standard deviation that we can use from the option platform. So go through that. And then we go through the core basics of the butterfly and the condor that most traders just don't understand. But once you understand it, it's kind of an aha moment. You'll really see a tremendous amount of value from it. And then I'll go through in the course a breakdown of every different variation of the butterfly, how, why, and when to use the call or put butterfly, wide wing butterfly, broken wing butterfly, ratio butterfly, broken wing ratio, iron butterfly, vacation butterfly, long condors, like I always say bubblegum shrimp, you know. And then the best, what are the time frames? Should you go out 1 day, 2 days, 10 days, 2 weeks? You know, what are the best time frames for the butterfly condors? And then, should you use stocks or ETFs? So go through that. And then how do you get those structures where you get 10 to 1 or higher? So you'll learn everything in this course, all, based on butterflies and condors. And then how do you profit from volatility collapse and theta decay, how that works? And then there's a whole part of the course on how to use the butterfly for what we call option pinning or expiration on the monthly option. So that's going to come, 12 times a year. So it's a great opportunity to get some profits on very low risk. And then I'll show you how to target those pinning points based on using Fibonacci and option activity. And then the next part of the course is the long condor, how you use these vertical spreads to create the long condor for neutralizing risk and lowering your risk and offering you big potential returns of 100, 200, 300%, and how, why, and when to use that long condor. And then part 3 is really we're getting into the hedging part. So a big part of this course is spent on just the hedging aspects of when to use the butterfly or long condor to hedge a core position or to defend a vertical debit spread or credit spread. So this part of the course alone is worth, the value of 97 or 197 or 297. And then you'll get in the resources, what is assignment risk, how that works, expiration risk, auto exercise, and then you'll get a trading library of different trades, past trades of butterfly condors. So you can kind of go back and look at them. I like to look at, trades. It kind of helps me to learn how they work. So all that is everything you're going to get here. And again, it's yours. You'll get a login, and this is all on the cloud. You can print out the PowerPoint. And so there you go. So here's some past nice feedback. This was from Pam. Excellent class, Larry, as usual. You under promise, over deliver. Wish I'd known how to do this hedging before I lost so much money on credit spreads. That's so true. And then here's Jim. Thanks again for showing all the many ways of getting out of trouble. Could have helped and helped my P&L. So Jim. So I'm going to fast forward here a little bit to show you the bonuses. So here's your survival bonus package. You're going to get my option trading for beginners. This is a new course that I put out on demand. So the benefits of options versus stocks, mastering puts and calls, how option expiration works, and then kind of the basic beginning option strategy, how that works, covered calls, and then using protective put. And then you'll also get my options beginners home study package. This is a really good beginning option program. My survival bonus, you're going to get my hedging tutorial. So this will show you how to either, if you want to hedge a specific stock step by step or a stock portfolio, how to figure out how many option contracts and how to hedge it. And that's using a protective collar. So really good little bonus there. We'll do a follow-up Q&A, which will be recorded, and you'll get a link to that. And then my option trading tutorial, which is a 60-page option guide with videos on the Greeks, option pricing, and probabilities. And then my 15 option strategy guide. So this is another 15 different option strategies of how to construct and when to use, like a back ratio spread or strangle, straddle. So you're really going to have your library of trading for options beefed up here. And then you'll get my printout here for your, this will be something you put on your desktop to show you what the Greeks are and what they mean. And then a trial membership to my trading club for 1 month. And that is access to my virtual trading room each and every day during the week. Daily market newsletter after the market closes each day during the week. Live Q&As every Tuesday and recorded, so access to that. 60% off on all courses and software. So you'll get all that here today for this one price of $97. And if I had more time, I'd be happy to answer whatever questions, but I'm pretty close to my time limit. But if there is any specific, I'll see what I can do. So that's pretty much it. So if you'd like to join us, please do. I think you'll get a lot of value and benefit from this course. Hey, thanks, Mark. Mark has taken, I guess this course said your option foundation is very beneficial. So thank you very much. Thanks again.
Okay, well, glad to be back, and thanks for inviting me. Today I'm going to talk about how the election has provided the best trading opportunity of 2020. And the proof is in the numbers. The Dow is up 2,400 points from the Friday low. That's one heck of a response. Let me talk about myself for a second so you can decide if I know what I'm talking about. I have 50 years of experience in the global financial markets, 10 years as the economist correspondent in Tokyo, Japan, and later the White House, 10 years running the international equity division at Morgan Stanley, little brief timeout as a Marine Corps combat pilot in Desert Storm, 10 years running the first international dedicated hedge fund, 5 years fracking for natural gas in Texas, and I still have oil under my fingernails from that one. And now 13 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry who is still working. My family origins are very humble. Growing up as the oldest of 7 children on a remote farm in Southern California, I lived the all-American childhood playing Little League Baseball and becoming an Eagle Scout. There wasn't much to do in the old days in California except hunting, so I picked up a job as a paper boy for the Los Angeles Herald-Examiner. Wasn't long before I found the stock pages, bought IBM at 20, sold it at 30, suddenly found a far better way to make money than delivering newspapers off the back of a bicycle. By the time I was 16, I earned enough money to fly to Europe. By the age of 17, I had visited more than 50 countries and spoke 4 languages. And that's one of the first newspapers I delivered in 1963 covering the Kennedy assassination. At UCLA, I majored in math and DNA research, which landed me a job at the nuclear test site in Nevada. Their yield didn't mean interest paid, but millions of Russians killed. I didn't see much of a future in that, so the government sent me to Southeast Asia for a few years of research, where I learned how to fly and jump out of perfectly good airplanes. There I advised the militaries of America's Asian allies. This is the Republic of China Army that I'm with. As the war wound down, I became a foreign correspondent for The Economist in London. When they learned I had a math degree, they switched me over to covering the Asian economy and the stock market. Ta-da! In those days, research meant carrying a .45 caliber Sten gun, machine gun, and after 10 years of service, all I got was this box of medals, which I trot out once a year on Veterans Day, which is next week. As a foreign correspondent, I covered China during the Cultural Revolution, was the first American reporter to visit North Korea since the Korean War, and covered the rest of the continent all the way out to India. If you're wondering why I'm so skinny in that picture, that's because there was a famine going on in China where 50 million people died. I figured out very quickly you didn't have to be that smart to make money in the stock market. Otherwise, Wall Street would have run out of smart people a long time ago. So I got into the industry, joining Morgan Stanley. After 10 years, I started my own hedge fund, and that's my ID card for Morgan Stanley, and I'm sure you're thinking, boy, the years have been cruel. They really haven't been that bad, but still, I rapidly became the top performing hedge fund manager of the 1990s, eventually bringing in a 1,000% return in a decade. Then the money really started to pour in. It's an understatement to say that when your income goes from the thousands to the tens of millions, it really has a big impact on your lifestyle. You get to do things like fly your own private plane around Europe, that's Land's End in England, drive the hottest car, go marlin fishing, and collect vintage Rolls Royces for a hobby. I sold my hedge fund in 2000, retired to go into the oil and gas industry. After making a killing there, I missed the stock market and started the Diary of a Mad Hedge Fund Trader in 2008. I now spend my days pursuing my first love, finding winning trade alerts, but now I do it from my 3 mansions in San Francisco, Lake Tahoe, and Zermatt, Switzerland, except I can't go to the one in Switzerland this year because Americans are banned from the country because we have such a high infection rate. I've quit turning millionaires into billionaires. There's far more satisfaction leveling the playing field for the average guy and teaching them how to trade, and that includes you. If I could take a $50,000 account, turn it into $500,000, that is more job satisfaction than I could ever get from anywhere. As you can see from my homes, I like houses with great views. However, every silver lining has a cloud. Last year I had to pay 5.7 million in taxes on 15 million in trading income. Ouch. I just thank goodness I can afford to pay it and not have to cut my lifestyle. In the little free time I have left, I pursue my other love, flying vintage aircraft on weekends. If you see an old plane flying loops over San Francisco or London these days, it's probably me. And that's my 1932 de Havilland Tiger Moth. Notice the design flaws, gas tank directly over your head, and no brakes. That's why we can only land on grass fields. We just land and pray. The ultimate luxury, of course, is to give to those who need it. As a Marine Corps veteran, I volunteer for grief counseling for widows and orphans, and am a major donor to wounded warriors. When the wildfires hit California, I visited the main evacuation centers and handed out $10,000 worth of Target gift cards. That's me visiting my in-laws' house, completely burned down to the ground. Notice the SIF box. They were looking for a wedding ring, which they eventually found. It didn't melt because it was made out of platinum. So there is a method to my madness. We do have a perfect storm here. The Fed has proven its intention to step in and run the printing presses on any 10% correction, which we've just had. Stocks are still overpriced on a short-term basis, but on a 3-year view, they are cheap because they have not yet reflected the massive improvements in technology that have resulted from the pandemic. A bond short position is far away the best trade based on the massive overissuance of U.S. government bonds. And let me get back to my story here. $6 trillion in stimulus spending will follow any winner of the election, massively boosting the economy. We're already seeing that this week, up 2,400 points in a week. Gold is breaking out to the upside, and today it's really going ballistic from hedging demand. The more stocks they buy, the more gold they have to buy to hedge it. U.S. dollar is toast because it's of exploding deficits. It's been in free fall all week. The best buying opportunity of the decade is here. And if you're wondering what I'm doing here, I'm doing aerobatics in a P-51 Mustang. And if you don't know what that is, this is my friend Geraldine, who I fly a couple of times a year out of Florida. It was the most powerful fighter of World War II. Global economy is bouncing hard. Q2 GDP was a horrific minus 31%, but Q3 is just up just as much, and Q4 may be the same. Jay Powell really wants a stimulus package, claiming the economy desperately needs fiscal help to maintain a recovery. It would turn the U.S. economy to 2019 levels by 2021 instead of waiting the extra year to 2022. With the election behind us, the roadblock to additional massive stimulus is gone. IMF forecast for this year is a negative 4.4% for the global economy, the worst since the Great Depression. The economy coming out the other side of the pandemic will be much more profitable than in the past, thanks to the enormous technology improvements spurred by the virus. All leads to a decade of rising stock prices, a second roaring 20s, and a new American golden age. This is all hugely pro-stock. These are the weekly jobless claims. We've been flatlining at 750,000, and that may be a permanent level that we're stuck at for years. Of course, the historic antidote, the government has already implemented the greatest stimulus in history at $6 trillion. That has unleashed the greatest QE in history at $8 trillion, increasing all the global QE of the past decade by 50% in one shot. When people come out of lockdown, they will engage in the greatest spending binge in history, igniting the next roaring 20s. Most consumption hasn't been lost, it's just been deferred into next year and the year after. This will create the strongest economic growth in history and will last for years. Stocks will rocket. We're getting the big post-election rally now that I had been predicting all year, really. It didn't really make a difference who won. The fact that it's over is the major incentive. We get possession of our televisions back. $5 trillion in new cash is coming off the sidelines right now. That's why the stocks have been going up so fast. Many of my stocks are up 10 or 20% just this week alone. Good news is that foreign investors have stepped in as big buyers in 2020, taking the indexes to new highs. The market will broaden out, moving beyond a handful of giant technology companies that we saw this year. The fastest market sell-off in history will be followed by the fastest market recovery in history. In 2021, both tech and recovery stocks run, meaning everything goes up. And boy, that's sure happening this week. This is our PE multiple. If you're worried about stocks being expensive, you're right. We're up at a 25 multiple. That is at the very top end of a 30-year range. However, moving 3 years ahead, we're really down to the lower levels of PEs down here. So that makes stocks a buy right now. This is my outlook. We had a double top in the market, a sell-off going into the election, and now it's off to the races. I expect to get new highs by the end of the year. We are about here, right in takeoff mode. It is a perfect time to sign up for a service like this because we'll be funneling trading ideas out to you every day, which you can execute immediately. The barbell portfolio is the way to go. Put 50% in big tech, 50% in domestic recovery stocks, including railroads, couriers like FedEx, credit card processors, banks, construction, and so on. This is NASDAQ. That is the place to be for all of this year. You can see signals sent out by our in-house algorithm. It tells us when to buy and sell the market on a short-term basis. It's accurate about 90% of the time. You can see we had a buy here, buy here. Oops, get out, take profits at the September highs, get back in and buy the bottom, buy right now. We're targeting 13,000 by the end of the year. Microsoft, one of our favorite stocks, new high on cloud takeover and blowout earnings. We had buys here at the beginning of the year, a buy here, and again, we're very bullish on Microsoft. We're targeting $150 in 2021. Amazon probably has a double from here. We'll be cautious and call it $5,000 by 2021. And again, we've been buying this really ever since the company came out 20 years ago. The most recent buys have been here, and then a sell back here, another buy. By the way, I did work with Jeff Bezos when he was the head of our bond research department at Morgan Stanley. Very smart guy, I have to tell you. PayPal, we love fintech, touchless payments of the future, targeting $250 by next year there. NVIDIA, the graphics card leader of all time. We've gotten a 10-bagger on this one. In 4 years, we could get another 10-bagger on this. It's an incredible company. For the short term, we're targeting $600. Salesforce, the customer relationship management on the cloud company of all time, looking to buy the dip there, targeting $300 in 2021. Second half of the barbell will look totally different. We haven't seen it for many years because we haven't had a cyclical economic recovery in several years. Focuses on economically sensitive companies, makes a great counterweight to the high growth technology stocks. We could spend all of next year rotating back and forth between the two groups. And don't ask me to lift this weight. That kind of looks like a very heavy barbell. Boeing, of course, is on the list. We think we get one more good sell-off in Boeing, and then it's off to the races once they get their 737 MAX flying again, and we're targeting $300. Banks, we love JP Morgan. That's the quality value play in the entire market. Bought the latest step. We see $130 next year, which is about a 30% gain from current levels. Visa, MasterCard, American Express, they'll all be winners. And again, you can see our algorithm came in with a buy here, a sell to dip that correction, and then another buy right now. Railroads like the Union Pacific, they do the most business with China, and with the new Biden presidency, a possibility, I would have to say, that trade with China will increase. Bonds, we are expecting a complete breakdown of the bond market. Bond prices already have hit a 4-month low thanks to a stronger economic recovery. Massive government borrowing is the story here. Inflation is failing to show. Another short selling opportunity of the century is in play. U.S. Treasury Bond Fund, the TLT, could plunge from 180 to 105 in the next year, taking rates from 31 basis points up to 325. You want to be selling every major rally in the bond market. We've been doing exactly that, selling these peaks, covering these shorts. We're now on the short side. We're looking for 140 by the end of this year. Here's your 10-year Treasury yield. And again, it's been flatlining all year, going nowhere. Foreign currencies, we had a short-term dollar rebound. Great opportunity to sell into. Massive QE and bond issuance is sucking the life out of the greenback. Euro has broken to multi-year highs as there are now more corona deaths per day in Florida than there are in all of Europe. That allowed Europe to reopen while we had to stay closed. British pound is soaring on our European recovery. Bitcoin jumps to a 4-month high on a QE trade. Aussie dollar jumps to an 18-month high. Keep selling all US dollar rallies. Its yield support is gone forever. There you can see the US dollar basket, and you can see that is definitely a major downtrend. Been going on all year. Got a rally to sell into right here, and it's bombs away right now. Australian dollar is our favorite among the currencies because thanks to its commodity exposure, it makes a great play, call option on recovery of the global economy. Also, a big resurgence of Chinese investment into Australia is going to take place once the pandemic ends. We got the low of 57 cents down here, made it all the way up to 75. We expect it to go 1-to-1 sometime in the next 3 years in the US dollar. That still leaves about a 40% potential gain on the table. Remember, we trade all asset classes all the time, long and short. Energy, we hate. We think they're going to zero. Hurricanes have killed the industry. Chevron is now the largest American oil company. Saudi production will cap any oil rally forever, keeping U.S. companies in money-losing territory forever. Much of the lost demand is permanent as the U.S. economy structures to a less transportation-oriented economy. Avoid all energy plays like the plague. Could drop by half in the coming recession. Oil overproduction means we could go back to $10 a barrel. Here is a 10-year chart for oil. We've only been playing this from the short side. Got to sell here, got to sell here, and we sold the rally back here, targeting $10. You want to look at a 30-year view, you really see the downtrend here is more pronounced with lower highs here and here, and again, targeting $10 with lower lows. So this chart goes back 20 years, a 20-year demand. Oil is going out of style. Precious metals we absolutely love. It's blasting through to new highs right now. Portfolio hedging demand piles on top of central bank buying, creating a big gold shortage. New QE infinity has sparked a rally. Collapsing US dollar is another incentive. Central banks are pouring into gold every month. Coin dealers are running out of American gold eagles. Buy every dip in gold and precious metals. And that is me at the gold market in Istanbul last year doing some Christmas shopping. I do tend to get around a lot when there isn't a pandemic. Here is the gold chart from a few weeks ago. Again, buy every dip, buy, take your short-term profit here, buy back down here, buy now. We're eventually looking at $3,000 an ounce in 2022, that's in 2 years, and that is about more than a 50% gain from the current price. If you like gold, you gotta like gold miners. They get 4 times the upside in a bull market. We have our buy signals here and here. And if you like gold miners, you have to like Barrick Gold. And we've been a heavy buyer of this for years now, and that is paying off big time. And that reminds me, how is Barrick Gold doing this morning? And it's up, I would say, 3%. So yeah, thank you very much, Barrick Gold. Just thought I'd check my position while I'm talking here. There is another alternative investment you need to look at, and that's the next trillion-dollar company, and that's Tesla. Battery costs have dropped by 80% over the last 10 years. and will fall by another 80% over the next 10, and may happen in 2 years if solid-state batteries can be mass-produced profitably. There's a second factory in Shanghai increasing production by the end of this year, and a third factory in Austin, Texas, and a fourth in Berlin, Germany, that will take Tesla to 1.1 million units a year by the end of 2021. What people don't get about Tesla is that the data collection is worth far more than the car. Collecting information on the miles driven has allowed them to build the world's best self-driving system, and that alone they can sell for $8,000 a car. Believe me, I paid it. U.S. electric car sales have risen from 0% 10 years ago to 4% of the market today, and will soar to 100% in 20 years. Tesla's already outselling all premium car brands in the U.S. combined, including Mercedes, BMW, Audi, and Jaguar, and has a 10-year head start which no one will ever catch. Many countries and U.S. states have banned the internal combustion engine by 2030 or 2040. Tesla is already the world's largest car company by market cap at $450 billion, and it could grow fivefold from here. This is the design of their new solid-state battery that will increase battery productivity by 20 times. And instead of having electrons go back and forth along the length of the battery, they wrap it around the central core. It's a really cool design. Here's the stock. My initial cost on Tesla is $3.30. I bought the stock 10 years ago after the IPO collapsed. Since then, I've gotten 150 move on the stock, and I think you can get another fivefold return from these levels. So we're looking to buy Tesla on the dips, targeting $2,500 a share by 2025. This is my latest Tesla. That's the high performance Model X with the ludicrous mode. Costs $162,000. Warning, if you are going to go from 0 to 60 in 2.9 seconds, bring lots of air sick bags. I'm immune to air sickness because I'm a combat pilot. My kids, not so much. So if you want to keep that new car smell, bring lots of extra air sick bags and towels in case of accidents. This is my first Tesla. It didn't do so well. Of course, even the best design in the world doesn't help when you get tail-ended by a GM Silverado by a drunk driver on Christmas Eve. I did use the opportunity to take the car completely apart. Here you can see the battery pack underneath the rear seat and the carbon fiber wheel well. A lot of people talk about Tesla these days. I'm the only one who's actually taken one to pieces. Don't play with matches. You could probably do okay just buying all the stocks I mentioned above and forgetting about them. However, the reality is that conditions for these companies change every day. They're all viciously competing, trying to put each other out of business. You don't get daily updates on the fundamentals. You could easily get wiped out. Today's big winner could instantly become tomorrow's loser. Apple itself has a 45% correction every couple of years. That's why you need someone like me to guide you through the thicket and avoid an out-of-the-blue blow-up. I gained financial independence for life, and so can you. All of this can be yours. Discover how to make thousands of dollars a year in extra income. Go from a complete beginner to a seasoned pro in weeks. Learn how to quit your day job and trade for a living full time. Trade from anywhere, anytime. Supplement your retirement income with the satisfaction of booking winning trades by the hundreds. And that's me struggling to keep a smile while it's 120 degrees on the coast of North Africa. The harsh truth is you really need my help. The majority of individual traders lose money. They lack the correct training and discipline to succeed. Most broker research suffers from grievous conflicts of interest. Wall Street is all about moving money from the uneducated to the educated. The easy solution to that problem is to get educated. Fidelity did a 20-year study and learned that their top performing investors were dead people. Why did dead people do so well? Because they never sell. And that's me talking to my last broker, Pinocchio. Actually found this shop in northern Italy where the legend began. You need a real pro to guide you through the market maze. The market is not monolithic, and 95% of it can be completely ignored. There are a few great sectors and a lot of awful ones. You can earn 10 times return on the great ones, as I showed you with the previous charts, but get wiped out by the losers. Let a 50-year veteran steer you to safe waters. Let me sit next to you and guide your hand on every winning trade. This is our secret weapon, our Mad Hedge Market Timing Index. It's an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators all day long. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that upgrades itself 30 times a day. Don't go to a gunfight with a knife. If you're trading against algos alone, you will lose. Algorithms provide you with a defined systematic trading discipline that will enhance your profits. And I'm not the only one using algorithms. I was walking on the Miami waterfront last year and found this mega yacht, and look what it's called, Algorithm. Obviously, it's working for more people than just me. Some 80 to 90% of all current trading is algorithm driven. This is 3 years of our algorithm, and you can see we get lots of sells at market tops, buys at market tops, bottoms, enough to make several round trips a year. It is a highly profitable trading mechanism. This is what it's done for us. This is our 10-year performance, or actually 11-year performance. We have done 2.7 times the S&P 500 over the last 10 years with far less volatility, averaging 37% a year annualized. And while the index itself gets these gigantic dips, like we got in March, like we got in December of 18, we're more or less a steady line that goes more or less up all the time. This is important because beginning traders tend to get flushed out on these big sell-offs and end up losing money on every trade. Bill was a struggling tobacco farmer in Virginia who wanted to supplement his fading income. After making $3.4 million with me, he still farms, but now he's growing grapes in California's Napa Valley and selling them to the high-end wineries. Philip was tired of working in the boom and bust of the oil and gas industry in Texas. After doubling his money every year for several years, he now earns a full-time living as a trader. Jackie was an Australian hospital administrator who turned $50,000 into $22 million with the help of me and became a major player in technology stocks. She now is retired in her 50s and spends her time cruising around the world when the ships are operating. So what do we do about all this? Stocks, you want to buy the next big dip. Bonds, sell rallies. Commodities, buy dips. Energy, stand aside. Currency, sell US dollar rallies. Precious metals, buy dips. If you are not up 54.54% in the past 12 months as I was, you are reading the wrong newsletter or following the wrong trade mentoring service. 37% a year for 11 years, beating the S&P 500 by 2.7 times. If you get that kind of return, you get to do things that other people can't do, like take the owner's suite from New York to England on the Queen Mary. Once you get there, you can take the Orient Express to Venice. Caution, every dinner is black tie, so be sure and bring 2 tuxes. And once you get to Venice, you can do all the island hopping you want on your own private helicopter. The very long view, here's where the big money will be made going forward. The 2000s and the 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy one as a global demographic wave brings on a new golden age. 85 million millennials will become big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, fade from the scene. That will create an economic boom that will last another decade starting in 2021. And that's me watching climbers come down from the Matterhorn from my house in Zermatt. This is what the Dow did in 1982 to 2000. Just to show you I'm not smoking California's most popular product, at that time the Dow went up 20 times from 600 to 12,000. All I'm saying is we're going to get a replay. And in fact, the replay has already started. We hit 6,000 back in 2009. We've made it up to 28,000 today. That is nearly a five-fold return in 10 years. And I'm just saying we continued that rate of return for another 10 years. That takes us to a Dow 120,000 by 2027. To show you how far along we are, we're halfway there. We're halfway from, halfway across the 20-fold increase in 20 years or in 18 years. We've gone from 6,000 to 29,000 on the way to 120,000. So we are here right now. All I'm saying, we just continue moving on like this for another decade. Except this time it's different. Technology is hyper-accelerating on all fronts simultaneously, and the pandemic has speeded up the rate of change. The development of functional quantum computers means that computational ability is about to increase a trillion-fold at no cost. All major human diseases will be cured, including coronavirus. Needless to say, tech and biotech stocks dominate in this scenario. The 90s had cheaper computers, cheap operating software, and a new internet. The 2020s will have 10 times this number of new technology drivers, and that is a quantum computer that gives you an increase in performance of a trillion-fold at no cost. So who will show you how to play the next 95,000 points in the Dow? Sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Discover how you can tap into the top-performing trade mentoring service in the industry, up 54% this year. Follow my research and market-beating trade alerts, and you will rake the profits in. Let a Marine combat pilot steer you to big profits. We trade single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. This is a typical month for us. Do 10 or 20 page trades a month, and you can see we made 16% on the S&P 500, 8% on a Treasury short, 14% on a Russell 2000 long, bought Amazon, Apple. Oops, stopped out of a loser in Biogen. We stop out of losers very quickly because we know 90% of the time the next trade will be a winner. Just a matter of time for tech and biotech stocks break out to new all-time highs. Watch this space melt up going into the end of 2020. Get ready to start reeling in those whoppers with Global Trading Dispatch. And yes, that is a 24-inch rainbow trout, which I caught in a lake in northern Nevada. Here's how it works. We saw an opportunity setting up in Micron Technology, so we sent out a trade alert to buy the stock. And this is what it looks out. Buy Micron Technology at 42.10 best, opening trade. For a $10,000 weighting, you needed to buy 238 shares. What happened? We got a 15.63% profit in 15 trading days. Did we just sit on our laurels and pat ourselves on the back? No, we sent out another trade alert that said take profits. Sell the Micron Technology at 48.58 or best. Closing trade. On this trade, we made $1,563 in 15 days. These are some of our big winners. Up 10 times on NVIDIA, up 77% in 10 months on Lam Research, up 2,240% on Baidu, and of course you already know about Tesla. With my global trading service, you get a daily research letter, instant trade alerts set out at market sweet spots, about 200 a year, and all the reasons to execute them, live bi-weekly strategy webinars with an interactive Q&A, special reports on urgent investment topics, invitations to strategy luncheons around the world. Once the world reopens, again, I used to do about 25 a year of those, more educational videos and webinars you can consume in a lifetime, access to a 13-year database on investment ideas, searchable by name and ticker symbol. I'll even give you the name of a good surfing camp in North Africa with a seniors division. Warning, it's a lot harder than it looks. This is what I'm not going to charge you for this service. I'm not going to charge you $100,000. That's what I charge my big hedge fund clients, and they're happy to pay because I make them many millions of dollars, especially this week. And I'm not going to charge you $10,000. That's what I charge my concierge clients who get my personal cell phone number so I can act as their investment 911. And let's see, we have a chat. Okay, and Anna, if you can put the link to our sales page in the chat box on the right, people will go to the dedicated sales page and take advantage of our offers there.
Sure, will do, John.
Okay, this is what I'm not going to charge you for this service. I'm not going to charge you $5,000. That's what I charge my advanced option trading clients. And by the way, every trade alert we send out has 3 flavors: a stock recommendation, an option recommendation, and an ETF recommendation. So you can use these to buy stocks for your 401ks, your defined benefit plans, your IRAs, no matter what. We have a flavor that fits absolutely everyone. Okay, we're not going to charge you $3,000. This is the cheapest price on my website and the lowest I've ever offered. And this is the real deal. Greatest product cost me millions of dollars. With the best customer service in the industry, running it cost millions more. Today and only through this webinar, I'll offer you 6 months for just $997. That is a 66% discount to our website price. Just click on the chat box on the right, and you can see the blue text in there. It says madhedgelandtrader.com/InvestorExpo. This is a limited time offer. We only take 25 new subscribers at a time, so it's first come, first serve. I can't wait to make you a top drawer trader. Just click on the link on the chat box on the right. Let me make the money for you to pay for your subscription. You make the trades, discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. Just click on the chat box on the right. 6 months for just $997. 90% of our customers cover the entire cost of the service on their first trade. If you buy today, we'll also include our Mad Hedge Armageddon portfolio. That is a portfolio of stocks to buy at the next market bottom and then forget about for the rest of your life. This is a business where you really need to have a gunslinger on your side. Also today, I will throw in a free trade alert. Buy now and you will instantly receive a trade alert with an extremely high probability of success. You can execute immediately this second since the market is open, and you can make some of the most serious money in your life. Don't leave money on the table. 90% of these trade alerts make money immediately. I'll even give you the chart of the secret trade alert, which you can only get if you subscribe to our service. Just click on the chat box on the right. And I'm not going to tell you what this is. This is an 18-month chart. And this is a great time to get in, and let me check the price and make sure it hasn't run up too much. And the answer is no, it hasn't. Looks like the market's taking a break here, doing some profit taking, so it's a good chance to get into this trade alert right now. So this is the offer you can't refuse, 6 months for just $997. And let me check my inbox here and see if anybody has come in yet. And I see, yes, I see Bill from Salt Lake City, Utah. Bill has just subscribed. Thank you very much, Bill. Promise to work hard to earn your money, and I'm sure you will love participating in this service. We just had Maria come in from Delray Beach, Florida. Thank you, Maria. And I can see a whole bunch of orders that have just come in. We have Eugene from Chicago, Illinois. Eugene, go out and get a deep dish pizza for me. Thank you very much. I'd love to visit Chicago right now, but the infection rate is just too high and there are almost no flights. Okay, we have Robert, just came in from Seattle, Washington. Robert, go over and say hello to my old friend, Jeff Bezos. Thank you very much for coming in. We have Roger from San Francisco, California. Good for you, Roger. You made the best investment decision of your life. Okay, I see we have a couple more minutes, and we have a ton of new orders coming in. Okay, let me read this here. We have Jim from Buffalo, New York. Thank you very much, Jim. Look forward to working with you. We have Jose from San Diego, California. Again, thank you very much, Jose. And let me check this other email here. Okay, so that is pretty much for it for today. It's been a pleasure speaking with all of you. Anna, are you ready to go?
Sure, we can. Thank you so much.
And don't think we're all crazy just because of the way we handle our presidential elections. I know it must seem very strange to you.
So true.
Just got another order come in. Okay, and this is Bill from Houston, Texas, just came in as a subscriber. Thank you very much. Okay, I'll take some questions here. Here's a question: do you trade stocks or options? And the answer is we trade all of the above. We want to make sure as many people as possible can use this service. Having a great long-term view is probably the most valuable tool you can have in managing your retirement funds, and also helps a lot to have some trading discipline, which you will certainly gain through this service. Okay, another question here. What is your outlook for 2021? And the answer is continued bull market, up at least 20%. But after the run we're having this week and through the end of the year, I would expect a couple of 10% corrections along the way. So stay long. Don't let the TV or your golfing buddy scare you out of your positions, which happened a lot of times this year. The only way you can get a 50% a year return is to be there and be aggressive at the market bottoms. That's exactly what we did a week ago. That's what we did in the March bottom after the initial pandemic meltdown. Okay, I think I am out of time. Are you good to go, Anna?
Yes, there is one. Let's take one last question. How much cash do you need to participate? 10,000, 40,000?
You know, we literally have college students trading from dorm room beds who start with 500. You know, our cheapest single position would probably be about $400. If you want to increase your that to 10 positions, then maybe a $5,000 portfolio would be a good starting point. And of course, we have people going, you know, from $5,000 all the way up to hundreds of millions using our trading system. It's been around very long time. After 50, takes 50 years of practice to develop a system like this. And I just do this because I love helping other people make money. It's got to be the most satisfying job in the world.
Good afternoon, everybody. Thanks for coming to today's presentation. Give me one sec here. Okay, sorry about that. I was just making sure everything was working fine. Today, I'm going to be talking about low-risk, volume-based order flow trading strategies. You know, one of the great things about Investor Expos is they have such a wide range of speakers. You know, the last speaker, Mr. Thomas, you know, he's more of a long-term view of the market. I have a very short-term, I have an intraday view of the market. You know, there is just so many different ways to approach the market. And you know, people always ask, you know, what's the best way to approach the market? Well, you know, you have to find the way that's most suitable for you. And today I'll be talking about using volume in your trading. And I'm going to teach you specifically how to identify volume behavior, how to turn volume into value, how to value the market. And I'm going to talk about 3 low-risk volume-based trade setups. Now, what I'm going to show you today is how to look at the value area, the volume on a micro level as low as bar by bar. And what makes value so useful is it's based on a perception of fairness. You know, as a trader, you should always be asking, is the market trading a fair price where participants are happy to transact? And which basically begs the question, is the market trading at value? You know, if the market is not trading at value, then it's going to start moving. And why order flow, right? Because I'll be talking about it, volume and value in context of order flow. Well, order flow gets you as close to what's happening right now in the market. You know, it's one thing, like I said earlier, right? You know, there's different types of traders. There's long-term traders and there's very short-term traders. I categorize myself as a short-term trader and intraday trader as opposed to someone that's willing to you know, buy a stock and hold it for 6 months, you know, through COVID, through the election, anything like that. You know, I find that could give you a lot of sleepless nights. You know, my nephew goes to Wake Forest and, you know, he's interested in stocks. And when the stocks are up, he doesn't, you know, we don't really chat much online, but when the stocks are down, you know, it's, oh my gosh, what should I do? You know, that's the difference in trading styles, right? I look at very short-term trading. By the end of the day, win or lose, that day is gone, right? I don't have to carry it with me overnight into bed, staring at the ceiling over, you know, is this position a good position or not? And with order flow, that allows you to get right up next to what's trading in the market right now. And the second reason is once you understand how the current trading activity is impacting the market and how it causes the market to move, you're going to understand the market better, right? We all want to understand the market, what's going on in the market. And by looking at the volume and by understanding what's happening in the order flow, you're going to have a grasp on why the market is moving right now. And lastly, order flow gives you an edge over other traders because you're going to see things they're not seeing, right? That's a big edge. You know, it's like playing cards and be able to see, you know, the person you're playing against, be able to see what, you know, what cards they're holding. And best of all, I'm going to show you how you can do this without past trading experience. You know, I've got a lot of trading experience, but you know, what I'm going to show you comes from that experience. You're going to be able to do this without having to use mathematical formulas, without complicated technical analysis, without macro fundamental analysis. You know, oh my gosh, you know, now, you know, potentially we have a new president. How's that going to affect the market? You know, you don't have to worry about that stuff. You know, without algorithmic trading tools, you know, everyone always says, oh, you know, the algos are out there to get you. Yeah, you know, that's another several hour long conversation. And I'm going to teach you how to do it without programming skills. You know, nowadays, you know, it's interesting to be a trader now. You know, if you go look at, you know, the job postings anywhere for, you know, hedge funds or, you know, banks, you know, required, you know, you got to have programming background. You know, most of us, you know, we don't have that skill. And you don't necessarily need that skill to become a trader. Now, this morning, it was very fascinating in the gold market, right? This is why I get excited about order flow, right? You know, gold was trading, you know, hit just about 1950 this morning, around 925, came off, right? Came off to the 1943, 42 and a half area, bounced up, as you can see here, right? We got the big candle, you know, all the candlestick guys. Oh, that's a bullish hammer, you know, market went up. But what was interesting, okay, this was fascinating. The market came down in this bar, stopped, then reversed and went up and made new highs. You know, as a trader, you know, this is why I love order flow so much, is because I can see why, I understand why the market came back to this level, right, in this box, why it came down to this level, stopped, and then started going up again, right? And in the order flow, this is just a normal volume footprint chart, okay? And if you're looking at a normal volume footprint chart, most likely you can understand why, right? It came down to the point of control, which is right here in this bar, this gray rectangle, right? The low of this red bar literally touched that level and rallied up. But what I'm going to show you is today in this presentation, by the time you walk away, you're going to understand why these two bars, not just this bar here, but even this bar, why they come down to this level, right, which is an area in this bar, and then started to reverse up, okay? So for those of you that are new to one of my presentations, just a quick about me. I've got over 25 years professional trading experience. I started on the CME floor with Dean Witter Reynolds. I left the floor when electronic trading started taking off, and I worked on the upstairs trading desk at Dean Witter, trading Globex, which is the CME, Project A, which was the Board of Trade, NYMEX Access, which was the NYMEX COMEX trading system, as well as all the other markets around the world. It was a big eye opener. When you're on the trading floor, I was in the currency quadrant in front of the Swiss franc and Deutschmark pit, and occasionally I'd go to the Japanese yen and British pound section on the other side of the floor, and people would be like, wow, you watch 4 markets, you must know a lot of stuff. Well, not really. When you're on the trading floor, you're very focused on that one market. But coming off the trading floor, it really opened up a big world for me. I was all of a sudden exposed to Eurex, to Life, to Cymex, to Tokyo, all these other markets. After Dean Witter, I left to join EDF Man, which is a big English trading firm that's over 250 years old. After EDF Man, I joined Commerce Bank in Chicago as a licensed Eurex trader with the exchange, but I was trading in Chicago, so that would mean trading Eurex out of Chicago. The market would open at 1 a.m., so I would come in at 10 a.m., catch sort of the second half of Asia, and then all day into Europe. After that, I joined Cargill, and I was the head of the futures trading desk in Chicago, and they sent me out to Singapore to set up a trading desk when the exchange in Singapore was closing, which I did. After that, I joined JP Morgan. I spent 8 years at JP Morgan in Singapore as vice president of futures trading. Okay, after JP Morgan, I left when my daughter was born, and I wanted to spend more time with my family because I realized that I can't spend 12 hours a day outside of the house. Basically, I was going in the office at 5. I was in the office ready to go at 5:30 in the morning until about 5 o'clock at night. I couldn't do that forever, especially after you got a newborn, right? That's not the life that you want. So I left JP Morgan, right? I left a nice paying job and security to do my own thing, right? I started writing a book on trading and trading for myself. Now, this presentation is not about me, right? It's about showing you how order flow is going to improve your trading results quickly. A lot of people think, oh yeah, I'm going to just sit down, start trading, and it's going to be a nice straight line up. I'm going to start making money instantly. Well, what it really looks like is this very squiggly line. It's, you're all over the place. You start out, move backwards, go up, come down. That's just the reality of trading, and oftentimes the reality of life. So if you stay to the end, I'm going to show you how to get a copy of my book that I just explained that I started writing after I left JP Morgan on trading order flow. There's no books on trading order flow. That's why I wrote one, because I have a lot of experience up to that point in 2013 with order flow, and there was just nothing available on the market, for traders to understand. It was sort of this vague thing, order flow, the whole Jesse Livermore reminiscence of stock operator. He was an order flow trader. There's a lot of great quotes in there, but it doesn't really get into the nitty gritty. That's what my book is, right? So I'll teach you how to get that. And one last thing, the charts that I use in this presentation are generated from the order flow software that I created, right, on orderflows.com. But what I'm showing you today, if you have another software, you can apply what I'm talking about today. But without me explaining it to you, you're not going to know what to look for. That's why I'm doing this presentation, so it can help you in your analysis and become a better trader. So just a disclaimer, self-explanatory. All right, so identifying volume behavior so you're not trading blind. All right, so as a trader, right, we've all looked at charts and see the market comes back to a certain level, then it keeps going up in its original direction. And this was crude oil, simple 5-minute chart, right? You see the market hit the low of the day, rallied up, came off to a certain level, and then rallied up from there. All right, well, why did it stop at this level? Why didn't it come down and test the low? Or why didn't it, just sort of keep going up? Why this particular level, right? As a trader, I'm sure you've all sat there and wondered, oh, if I could just figure out why this market, stops at a level and then keeps going on. Well, people say, well, there was support here. Well, yeah, I mean, it's hard to say that definitively as the market is coming down here. It's one thing to look at it after the fact. The low of the day is down here at 21. We're about 15 points higher right now, 15 cents higher. And that's where volume comes in, right? If you're looking at a normal bar chart, you don't see volume, you just see price, right? Volume is the most underrated market variable that's used by traders. And if you know how to analyze it and interpret it, you'll be able to see market turning points develop and anticipate pullbacks, right? Like you have here, this pullback, and market trends, right? So this is that crude oil chart right here. This is that box where we pulled back to. Well, it's related to this, right? Right in here, all this stuff that was going sideways, it's not pulling back to the low of the day. It's not a half back, it's not a 50% retracement. But why? Well, it's because it's related to the volume. Now, if you look at the order flow, right, you can see points of controls sort of lining up at 35, 37. Now, I'm not getting into the minutia of order flow in this presentation. I'm assuming most of you guys have some background in order flow, right? So I'm not going to be talking about delta imbalances or points of control, right? So when I say point of control, that's the area in this bar with the most volume. Okay, simple. Okay, every bar has one. But you can see it's sort of lining up in here. Yeah, you can sort of make that guess that, yeah, that there's probably support, but how do you know it's support? How do you know it's resistance, right? Well, obviously it's going to be support if we rally up and we come back down to it. But, for a lot of traders, sort of identifying that is, it's a bit tricky because, they just see these point of controls in every bar and they think, yeah, is that important or not? But it is, right? And analyzing the volume that you see on the bid and the volume on the offer that traded, you can see where institutions are building up a position or distributing one. Transacted volume is what's going to help you see how fast the market is moving. So we got a market that's moving sideways, right? And we got heavy volume sort of coming in around this 35, 37, 35, 36 area, okay? So that's important to note, right? But who wants to spend all day looking at numbers and trying to put it in context, right? You'll go, that's too difficult, right? There's got to be an easier way, and there is, right? There is. You look at the value area for a bar. Now, value area, the term value area is a phrase most traders are familiar with, right? And if you can break it down on a bar by bar basis, right, you can understand where value is forming over time, right? That's how you determine value, where the market is trading over time. If a market is, this is a 5-minute crude oil chart. If from 12:20 until 1 o'clock, basically the market is trading around 35, the value areas, even though the market goes up and down, right? The value areas is sort of forming around the 35 area. That's telling you where value area is. That's telling you where support or resistance could be. Now, the value area is a primary component that's derived from market profile analysis, right? And it shows you the range of prices that reflect the most interest on the part of buyers or sellers. Most traders analyze the value area on a day-by-day basis. What I'm telling you right now is to look at value area on a bar-by-bar basis. Okay, and people say, Mike, you're crazy. Value area on a bar-by-bar basis. Well, that's how you turn volume into value, right? Volume is a data point, right? There's a lot of software out there. People post these charts every day up on Twitter or on Facebook, the volume profile for the day, right? And what are you really keen on in volume profile, right? Well, most important thing you're looking at is the value area. Second thing is probably the point of control, where the market's trading in relation to the value area, where it's trading in relation to the previous bar, or in this case, previous day, because most people are sort of taught to look at it on a day-by-day basis. Now, The value area in market profile or volume profile terms is where 70% of the day's business is conducted, which is basically one standard deviation. Okay, yeah, I understand, for a lot of you guys, you think it's 68% for the standard deviation. 70% is good enough for me. There's always price and value, but they're not always the same. Okay, so seeing the value area, right, in a bar where the volume is where the most volume in the bar is transacting, not the most volume, rather, where 70% of the volume is transacting, is going to help you understand where we're trading in that bar relative to current value, and as well as where we are relative to where value was on the bar before. Now, again, how is that different than looking on a daily chart, the daily profile, and doing that same analysis? You're just taking it a step down. And the reason why value is important is because it's where trade is being facilitated, okay? Where trade is not being facilitated, where it's difficult for a big buyer or a big seller, a big buyer to buy or a big seller to sell, that's going to be an unfair value. Now, again, here's gold. This is yesterday, right? A lot of these markets, I'm going to show you gold, I'm going to show you crude oil today, I'm going to show you euro currency, E-minis. It's the same concepts in different markets, and on different time frames: 5-minute chart, 1-minute chart, tick chart, range-based chart, volume-based chart. I don't use a Renko chart, but I'm sure it would apply the same there. This was yesterday in gold, right? We got this nice run up, right? You can see running up, put in this big value area at the swing high, and then the bar closes outside, right? We open up above value of the previous bar. We close down well below value of the previous bar. We open up inside value of the current bar, close well outside of value. What do you think the market's going to do? It's rejecting these higher prices up here, obviously. It's rejecting the previous value, right? And all of a sudden we're trading lower. And, over the next 30 minutes, you got a quick sell-off of, from 1906 all the way down to 1900. Here's gold on a 1-minute chart. That was a 5-minute chart that I just showed you. Now we're coming down on a 1-minute chart. Okay, we come up to the high, start to go sideways, right? We see value areas going horizontal, right? We've got value, 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 breaks a little bit, and value, 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 comes up, potentially going to go back in, go back up or not. Well, where do we trade? We trade back into that value area from earlier, right? This area where you got these 3 value areas sort of lined up around the 1934 area. This bar comes up back into that 1934 area, hangs in there, then the next bar opens up, we close outside that value area. So, then just sort of hang around, go sideways, sort of test that value area again, the value area from earlier, rejects it, starts trading lower, and then finally breaks, right? So you can see how we're coming back up into this value area right in here. This on a 1-minute chart, we're forming this value area, not at the high of the day, just off the high of the day. And every time we come back in it, we reject those prices, and the market, what do you think the market's going to do? If you come back into the value area, then come out, come back in, come out, and then finally, it's pretty self-explanatory. Now this is E-minis. This is a 1-minute chart. Value area. This is where we talk about being on the right side of the market at all times. This is where value area is going to help traders, right? You can just see how value area keeps migrating higher every single bar. Now, granted, this is this morning at 3:30 in the morning. Whether you're trading, in the middle of the night, or Asian session, or cash hours, you're still going to look at the same things, because what you're seeing in the value, every bar has value, whether you're looking at a 1-minute chart or a 5-minute chart or whatever. And if you see the value areas going higher every single bar, it doesn't take a rocket scientist, after you rally up from 75 all the way up to 85, we're in a trend. Well, you could pick it up really quick, right? We have this value area forming in here over 1, 2, 3 bars. You start breaking down, then you trade back into that value area, 1, 2 bars, then you break out of that value area, right? That's the go time, right? And it's telling you right in here around the 34.78, 34.79 area, rather than getting in late, at 83, 84. right? That's how value is going to help you. Once you start to internalize the value area and where it is building, you'll go a long way towards staying on the right side of the market, right? And being on the right side of the market, it's going to save you a lot of money and headaches. Again, this is the value area. You can see here, this is a 5,000 volume chart. Now, I'm showing you different charts. You don't have to keep every single different type of chart frame open, but everybody trades their own chart, right? You have to trade a chart you're comfortable with based on, your trading, right? I won't look at a 5,000 volume chart to trade off of, but I'll look at it as a reference. So you can see here, this is yesterday, election day. Or sorry, no, the day after election day. This is the 4th. We got 1, 2, 3, 4, 5, 6, 7 bars. Basically, the value area is roughly about the same, right in here. Yeah, it's going sideways, okay. Then obviously this next bar breaks down. This value area in this bar here below any of these previous value areas, right? So what do you think is happening? Value has shifted. Now you're out of balance. Before you're in balance, now you're out of balance, right? It's a lot easier concept to understand when you think of terms of balance and out of balance, right? And what happens? The market, again, puts in a nice sell-off. This is a 1,000-tick chart. Similar thing. This was this morning at just before 8 o'clock. Right? And being on the right side of the market, right? Obviously, value area, value area, value area, value. What's value areas doing? They're going lower, right? There's no sense fighting this. If this market pulls back here, you got this green bar. Everyone says, well, I got all these red bars. I got a green bar. I should get long. Well, why, right? You should be looking at what's happening in value area. Yeah, even though this bar is, is green, starting to go up, but you notice as value is forming in this next bar, we're rejecting this previous bar's value. What do you think is going to happen? Well, the market sells off from 93 all the way down to the mid 80s. So generally, the longer amount of time a market spends in a value area, the greater the value, right? The greater that area of value is going to be. Now, value is determined by the market itself, right? It's not assigned by some analyst that says, oh, there's value areas here, or some trading guru's levels that he puts out. Yeah, I think value is here based off this bar chart. Well, you're not looking at the volume. How are you going to figure out where value is? Markets determine value through their rotational process. And this was euro currency this morning, okay? Market rallied up, right? We hit this high 118.69, came off, came back up. We put these 2 wiki candles in here, right? You got the big wick up, the big wick up. Markets rejected, sold off from, the 50s down into the 30s, quick 20-tick move. Okay, well, why did it just come up to this level, right? It came up here. Well, people say, well, that was your earlier high. Now it's become, whatever. No, it's fairly obvious if you're looking at the value area, right? If you're looking at order flow, you can see where this value is here. This area from just before 7 a.m. all the way up to 7:30, that's your value area for this time period, right? You don't need to look at the value area for the entire day and figure it out. If you're looking at the whole entire day's volume profile, I should have screenshot it. It's not going to give you much information on why this market just pulled back right to this level, right? And how this is a nice short opportunity, right? That you rejected this level up in here. Even the next bar started coming back up right into that value area, rejected it. You have these nice probes up, all of a sudden, boom, can't go anywhere, market sells off nicely. Again, this was that gold futures chart I was showing you earlier, right? Why did this bar pull right down to this level in here of this bar earlier? After this, we even went up, obviously made new highs. And if you're just looking at the volume footprint chart, it might be easy to see. Say, yeah, well, it came back to this point of control from earlier. Okay, that's a clue. But if you're looking at the value area, it came right into this value here, right? It even put in on this bar, this value almost overlaps here. We rejected this value from earlier, right? We came back in there, stopped, rallied up. Next bar opens up, we trade into that value area. We reject this bar's value area, market moves back up, right? Then we rally up to new highs. All right, so let's get on to the low risk trading opportunities, right? That's what you want to see, how to use it in your trading. And there's three setups I'll talk about. First one is value area gaps. Uh, when a market starts to run, momentum is going to show up. You're going to see a migration of value, right? And oftentimes you're going to see each bar's value area gapping higher than the previous one. Now, oftentimes we will fill the gap, but it doesn't have to. You know, it could just simply be a gap and go move, right? We could come in and open up. Now, on a normal footprint chart or candlestick chart, you know, markets can look choppy, right? You just see a bunch of green candles. Well, market should be going up, right? We've all just tried to analyze the candles by themselves. You get long, and then what happens? The market stops and reverses, which isn't very useful, right? And you know, again, you know, a lot of people like to look at the market after the fact and say, "Oh yeah, it was so obvious this market was going up." You know, you can see, you know, we close higher, we close higher, we close higher. Yeah, but you know, you sort of need a bit more information, right? You want to know where's value, right? Where's the volume trading? You know, is it going higher or is it going lower? And by looking at the value areas, it opens up a whole other form of analysis, gap analysis, right? Most of us are familiar with gap analysis and what it means, you know, can we pull back into a gap? But you can see here, after we hit the swing low, value area started forming higher, then a big gap up in the value from the previous bar, then the next bar, another gap up. Come in, we fill that gap in this bar, and then we gap higher. Again, gap higher, right? As the market's moving up. Momentum, when you're starting to see gaps in the bars in terms of value areas, you know momentum's on your side. You know, look at a daily chart of anything, you know, stocks, futures, or, you know, Bitcoin, whatever. When you know that when you start seeing these gaps in the bars just by themselves, the market's got momentum, it's moving. But oftentimes you don't see these gaps if you're just looking at normal bar charts, right? You don't see a gap here, right? You don't see a gap here. You don't see a gap here. But if you're looking at the value, right? So I talk about being able to see what other traders can't see. You can see there's a gap in value, a gap in value, a gap in value. Now this is crude oil 1 minute chart. Previous one I think was what was that? That was gold. Now this is crude oil, right? Similar thing, gap higher, goes sideways, forming some value, starts trading up, gap higher, right? So you can see areas of market momentum, right? And you know what was interesting about this one here, right? You have this gap right here. You go sideways, you got 1, 2, 3, 4 value areas, basically at the same level. This bar comes down in here, value area high of these two bars, right? Stops, reverses, goes up, 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 up. More gaps. This is euro currency. Okay, yeah, we're mostly going sideways in here, but you got a gap here. You got another gap here before the market makes its run. You know, and if you're watching this in the order flow, you can see that. You know, other traders aren't going to see that happening. You know, basically two gaps right after the other, right? That's what you want to look for, is these groupings of gaps in the market, so you can participate in the move. Now this is gold. This was on election day, and you know, this is very fascinating. You know, when you make new highs, right? This was a market making new highs, and you're putting in value areas above the previous high. That's very bullish. Okay, and you can see you got a gap, but more importantly, you're putting in a value area, a new value area above the old high. I mean, it's the recent high, which was just made a few minutes ago, and then go higher, more value being formed above the earlier high, a new high being formed, more putting in value above the previous high. You know, yeah, it's nice that the value area is coming in above the previous value area. That's important. But when you're getting into new territories, right, new highs of the day or new lows of the day, watch where value is forming, right? As you see here, you know, this market, when it starts stalling out, we're not putting in higher value, right? We're not putting in higher value anymore up in here. right, as the move is stalling out. But if you keep putting in the higher value, there's more strength to the market. And if you're just looking at a normal bar chart, this is that same chart, but a bar chart here, right? This is that chart here. You're not seeing how strong this move higher is, right? By putting in the value at these higher areas, right? When you see that value coming in at these higher levels, that just gives you a better clue as to the strength of the move up. Now, value area builds is the second setup I'll talk about. And I sort of talked about it a little bit earlier, you know, when you got a few bars with value area sort of bunching up together. And it's when the value starts to expand horizontally. Basically, the market is facilitating two-way trade at a price level, right? It's found a fair price where people, buyers and sellers, can transact with the market not moving too much. Okay, so for example, this was yesterday. This is a 5-minute E-mini chart. And we've got 1, 2, so basically for a half hour, more or less, market is moving sideways here between 58 and 60, 61 and 3/4, or 61 even. Right in here, 1, 2, 3, 4 bar, 5 bars, value areas basically overlapping, right? Or as you can see, previous, you have value areas not necessarily overlapping over consecutive bars. Oftentimes the next bar value area will spill into the previous one. That's a different form of analysis, but this is where it's going horizontally. So this is what happened. This is that area right in here that I was just talking about. Boom, we break out of it. Put in value area above the previous high, right? That's important. Put in another build coming in here. Boom, market breaks out, higher value area, right? That's how you know that this move had strength yesterday, when we would put in new value areas above the highs, when we make a new highs. Now this is crude oil, okay? The similar thing, you got a build forming here, right? You're going horizontal, you're putting in a value area, value, 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 and then boom, it gaps right up here, right? And another gap right here, but once you put in this value, this build here, basically 7 minutes forming value here, and then all of a sudden, boom, the market jumps up. You can put in other forms of analysis in terms of imbalance and delta, but if you're just looking at the value area, something's afoot already, right? Obviously, this next bar, you got 4 imbalances, 4 buying imbalances, and we got a quick 30-cent move up, right, as we came out of this value area. But the sign clue was right here. As we came out of this build, we got a gap here. Obviously, the next bar, another gap. That's a good sign as well. But by the time this bar closes, you should be looking at getting long somewhere in here at 55. And again, where would your stop be? Well, you have this value area. This is going to be your support. So, this is the area you're going to be watching. If the market pulls back, the market could pull back into this area and then keep going up. But if it starts breaking down through this area, that's where you're going to be getting out, right? You're not going to be getting out at a swing low, which is, 10, 15 cents lower. You're going to be getting out here. That's why I talk about being as close to the market as possible, right? You're finding this bit of information that's generated by the market participants here, that there should be support here if we were to come back here. If we come back here, there's no support. That's where you get out. You don't let your stop, 15 cents lower stop you out. You could get out based on what you're seeing in the order flow. It's another example. This is gold this time, right? You got this nice build here forming over almost 8-9 minutes. Breaks away here, comes back in, tests that area, tests that build, rejects it, closes down, obviously, and works its way down, right? You could be getting in as quickly as the next bar as you come out of this build. And again, the quicker you get into a position based on how you read what's happening in the order flow, the tighter your stop is going to be. The tighter your stop is going to be, the lower your risk is going to be. You don't have to have a stop up here at 1905 or something. You know that if this area in here can't hold, chances are we're going to go higher. Now this is NASDAQ. This is a 30-second chart. Okay, this was fascinating. This is similar to sort of that gold chart that happened this morning. This is yesterday. Now NASDAQ on the order flow, right? It gets confusing for a lot of people. If you're trading NASDAQ, on a longer time frame. By a longer time frame, I consider 1 minute chart in NASDAQ a long time frame. Obviously, you get these enormous price swings. And you can see here, this is just a 30-second chart. We got a range from 24 up to 44 in 30 seconds. But what was fascinating about this pullback? Where did it hold? It held right where you had this build forming, 1, 2, 3, 4, 5, 6, 7 bars right in here. It came right down to that level, right? And it held. So even if you're getting long in here, 36, 38, you know that if we hold this area in here where this build is, you're looking pretty good, right? And the market immediately snapped back and rallied like a mother. This is E-minis yesterday, right? 30-second chart as well on the E-minis. You got this nice sideways activity going on in here. Then you got that gap right here, right? That's go time, right? You got the imbalances as well, but that's telling you it's go time. Just go ahead and get long. You're going to put your stop just on the other side, possibly of this area. But if you gap and go, forget it. We're not even going to retrace back in there, right? That's a nice low risk trade. Now, the next one I'll talk about is what I call the EVA, right? It's how we use order flow value areas in our order flow software. Now, I've shown you two ways to use volume in terms of value in a bar, but honestly, it's going to take time for you to be able to see through it, see it in observation by getting screen time. And there's other ways to use value area. I just showed you two, right? There's so many other ways. So let me say, let the software help you. Let the software tell you where value areas are bullish or bearish. Now, the Order Flows Trader, which is the software that I offer, that I've been the main proponent of for the last 5 years, tells you where value area is bullish or bearish. Okay, so again, if you're looking at a normal volume footprint chart, even if you have value areas drawn on your bars, it can get confusing for a lot of traders. Is this one important or is this one important? I don't know. Let software highlight that to you. And this is the beauty of software, is it will do that. All right, you can have a software tell me if this is bullish or bearish. That's the whole point of using trading software as a tool to tell you when market conditions are bullish or bearish. In this case, bearish value areas are going to be highlighted red, bullish ones will be blue. And this is up to yesterday at 2 o'clock, 2:02. This is what happened after those are those two bearish value areas. And you see the market sold off 10 points over the next 5 minutes, right? That's how useful having software that highlights this stuff to you is going to be. Here's another example. This is on election day, right? On a 5-minute E-mini chart. Like I said, 5-minute chart, 5,000 volume chart here. Here's a bullish one, right? This is yesterday. A nice bullish one here. Actually had another one, up here near the high, but this is where telling you where you should be getting long down here at, in the 60s, 67, 68 area for a nice 10-point move up. Here's gold, 100-tick chart, bearish value area. Nice move down. So you want to take complex things and make them simple, right? And honestly, for a lot of people, they're put off with order flow by looking at all these numbers. It's daunting. I get that. When I first looked at an order flow chart, I thought, what the hell is this? All these numbers. And I understood what they mean, but I was, oh gosh, do I really want to sit there and analyze this stuff? And that's why I created my company, Order Flows, is to take that information and highlight this stuff to me on the chart, because I know the value of looking at volume, what's being traded on the bid, what's being traded on the offer. I know the value of that information, right? That's why all these HFTs, these hedge funds, that's why they pay big money to have access to, the order flow, is because it's important, right? They're able to see things that other traders aren't seeing. Everyone, these algos are out to get you. Well, all they're doing is analyzing the order flow, right? And making good decisions off that. So in the past 40 minutes, hopefully you'll agree it's time well spent. Honestly, I can't cover everything in a 40 to 60-minute training session, but I got a special offer, so you get everything you need to know about order flow. And in fact, today I'll give you a very special deal. And what it is, it's the Order Flows Trader 3.0 for NinjaTrader 8. My software runs on NinjaTrader, everybody. Okay, that's the software that I use in trading. I find it to be the most useful, the most easiest to use. I'm not a programmer. I don't understand, how to program stuff. I like a simple to use interface, and NinjaTrader is that. I have a programmer that does all my programming. I like to be able to turn on my computer, fire up a chart, and instantly see things rather than have to go make all of these adjustments. And NinjaTrader helps me with that. The Order Flows Trader, it will run on the free version or the paid version of NinjaTrader. There's two versions. It will run on either one. And it's the volume footprint chart with 17 pre-programmed order flow tools. And it's easy to set up. It just takes a minute or two. And normally I sell it for $8.99 on my website, but you're not going to be paying $8.99 today, right? And really the Order Flows Trader it takes my knowledge of trading with order flow and puts it on the screen for you. So you can see what the institutions are doing. But I realize that having order flow software is one thing. You still need to know how to use it. So I don't just give you the software and say, go figure out order flow on your own. I provide a lot of education on how to trade order flow. And I have an order flow trading course. Normally I sell it for $297. You're going to get it for free today. I also have an Inner Circle video series. There's 56 videos on advanced order flow training. You can get it for free. People that want access to this got to pay, just these videos alone have to pay $497, basically $500. And I give you that for free as well. So you're going to get the software, the training, the Inner Circle video series. But it's one thing to learn how to read order flow from videos and books, right? You want to be able to ask me questions, okay? And I do every week for the last 2 years. I do a live training session on Tuesday nights where users can join and ask their questions on order flow, ask me to explain things on a particular market, things that you're struggling with in your analysis. And if you can't attend, the videos are all recorded and you can watch them. You can see there's 96 videos so far. There's a lot of people that sell software, then sell you training additionally. For what? You got software, you need to know how to use it and what to look for. People charge, a couple $100 a month just to, have, train you on their software. That's stupid. They should be doing that for free. And I offer that for free. So you get my software, training, extra training, live training for just a one-time payment of $749. Go to orderflows.com/off3. There's no recurring charges. You're not going to get billed $200 a month or $250 a month. No, you just pay a one-time payment, $749. We try to keep it low so more traders can access order flow. I think order flow is a great thing. It's not like order flow. Once more people start reading it, then it's going to diminish the edge. No, it's actually, in fact, it's the opposite, right? Because once more people understand what's happening in the order flow, it's going to help the market move in that direction, right? So go to orderflows.com/off3.html. Scroll down to the bottom of the page. This is what the page looks like. Takes you to this button. Click here to buy now. This is where you get started. You can see what you're going to get. All right. It goes to PayPal. PayPal processes your payment. Please note, all the information you're going to get goes to your PayPal registered email address. So whatever email you enter right in here with PayPal, that's where your information is going to be sent. And again, it's just a one-time payment, $749. So you're going to get the Order Flows Trader 3.0, the training course, the Inner Circle video series, live weekly group training, and I got a special bonus for Investors Expo, my Order Flows playbook, as you can see down here. Normally I sell it for $297. You're going to get that today for free as a bonus. So if you're interested in my book on order flows, go to orderflows.com/book.html. Be sure to put the book.html at the end. Enter your name and email address, click submit. It will take you to a page where you can go and download the book. Unfortunately, you're not going to get a hardcover copy of the book, but you'll get the book that you can download and read on your phone, on your tablet, print it out if you want. It's up to you. It's a lot of information. If you're new to order flow, it's going to help you in your trading in general. Go to it. So you got to get started. Just go to orderflows.com/off3.html. Remember, there's no recurring payments, any other payments in the future. You will need to pay your data fees, of course, for a live data feed. And if you're on a paid version of NinjaTrader, you got to pay for that. But it will run on the free version of NinjaTrader as well. If you just want to use NinjaTrader as your charting platform and enter your trades through a different platform, a broker's platform or your phone. Some people like to trade on their phones for some reasons. So you got to get started. So that's all. Go to orderflows.com/oft3.html. I think I'm out of time now, Anna. Don't have time for questions, but I'll take a look at them. And if you got any questions, you can always email me, Mike@orderflows.com, and I'll do my best to get back to you.